Before 1934, the American stock market operated on a single unwritten rule: buyer beware. No federal regulations required companies to tell investors what they were actually buying. No rules prohibited trading on insider information or manipulating stock prices. There were no requirements for financial disclosure, no limits on leverage, and no federal agency with the authority to investigate fraud or prosecute the people committing it. If you knew that a company was about to report terrible earnings because you sat on its board of directors, you could sell your shares before the announcement and pocket the profit. That was not a crime. It was considered smart business. If you and a group of associates wanted to artificially inflate the price of a stock by buying and selling it among yourselves to create the illusion of demand, waiting for outside investors to buy in, and dumping your shares once the price peaked, you could do that too. It was legal. It was common. And on Wall Street in the 1920s, it was the way business was done. The consequences of this system would eventually devastate the American economy on a scale that nobody anticipated. But the road from an unregulated casino to the creation of the Securities and Exchange Commission runs through one of the most extraordinary Senate investigations in American history, a stock market crash that erased 89% of the market's value, and a presidential appointment so ironic that it sounds like fiction. The New York Stock Exchange was established in 1792 when 24 brokers signed the Buttonwood Agreement under a tree on Wall Street, pledging to trade securities among themselves at fixed commission rates. For the next century and a half, the exchange operated as a private club with its own membership rules, its own trading procedures, and its own internal discipline, all conducted with minimal government oversight. The exchange's governing committee set the rules for its members, and its members policed themselves, which worked about as well as any arrangement in which the people being regulated are the same people writing the regulations. The federal government's position was that the stock market was a private institution conducting private business between consenting adults, and that investors participated at their own risk. This philosophy, rooted in the same laissez-faire economics that had governed the country's approach to labor, food safety, and every other area of economic life, assumed that buyers and sellers had equal access to information and could make informed decisions about what to buy and what to sell. The assumption was false. Insiders had access to company information that the public did not. Professionals had access to trading techniques that ordinary investors could not replicate. And the exchange's own members had access to the order flow that showed what everyone else was doing in real time. The playing field was not level. It was tilted so steeply that the professionals who stood on the high ground could see everything, while the ordinary investors at the bottom could see almost nothing. This asymmetry worked well enough when the market was small and participation was limited to wealthy individuals and professional traders who understood the risks and could absorb the losses. But by the early 1900s, the stock market was growing rapidly, and a new class of investor was beginning to participate: ordinary Americans with modest savings and limited financial knowledge who saw the market as a path to wealth and had no idea what they were walking into. The 1920s accelerated this transformation beyond anything the market's founders could have imagined. The American economy was booming after World War I. Industrial production was soaring. New technologies like radio, automobiles, electrical appliances, and motion pictures were creating entire new industries and fortunes seemingly overnight. Wages were rising. Consumer confidence was high, and the stock market, which had been a relatively obscure institution for most of the country's history, became the center of a national obsession with wealth that cut across every class and every region of the country. Newspapers ran daily stock market columns. Shoeshine boys and taxi drivers traded tips on which stocks to buy. Dinner party conversation in New York, Chicago, and San Francisco revolved around the market's latest gains. Radio programs broadcast stock prices alongside baseball scores. America was in the grip of a speculative fever that made the current price of a stock seem less like a financial data point and more like a measure of national optimism. The mechanism that made this obsession possible, and that made the eventual crash so catastrophic, was margin buying. In the 1920s, investors could purchase stocks by putting up as little as 10% of the purchase price in cash and borrowing the remaining 90% from their broker. This leverage was extraordinary by any historical standard, and it was dangerously seductive. If you had $1,000, you could buy $10,000 worth of stock. If that stock went up 20%, you had not earned $200 on your $1,000 investment. You had earned $2,000, a 200% return on your actual cash. The math was intoxicating, and millions of Americans who had never owned a single share of stock in their lives, who had no understanding of financial markets and no experience with risk, began pouring their savings into a market they trusted entirely because it had been going up for years. But margin worked in reverse too, and most investors did not think about that until it was too late. If your $10,000 stock position dropped by just 10%, you had lost your entire $1,000 investment. If it dropped further, you owed your broker money you might not have. The leverage that magnified gains would magnify losses just as ruthlessly. What most of these new investors did not know, could not have known without access to information that was deliberately kept from them, was that the market they were entering was systematically rigged against them by the professionals who ran it. The most common and most profitable form of manipulation was the stock pool. A pool was an informal syndicate of wealthy investors, often including corporate insiders, well-connected brokers, and occasionally the very specialists who were supposed to maintain orderly trading on the exchange floor. The participants would sign a written agreement, sometimes on a single sheet of paper passed around a private dining room, pledging to collaborate on driving up the price of a particular stock and to share the profits according to a predetermined formula. The mechanics were straightforward and almost impossible for an outside investor to detect. The pool members would begin quietly accumulating shares of a target stock, creating genuine upward pressure on the price through their purchases. Simultaneously, they would engage in wash sales, buying and selling shares among themselves through different brokerage accounts to create the illusion of heavy trading volume. A pool member might sell 1,000 shares to another pool member, who would sell them to a third, who would sell them back to the first. The shares went in a circle, but the trading tape showed thousands of shares changing hands, which looked to outside observers like a stock that was generating enormous market interest. The pool members called this phase advertising the stock, and it worked because of a basic human instinct. When ordinary investors saw a stock rising on heavy volume, they assumed that someone with better information knew something they did not. They bought in, hoping to ride the momentum. Once enough public money had flowed in and the price had risen to the desired level, typically 20 to 30% above where it started, the pool members would dump their shares in a coordinated sell-off, taking their profits while the stock collapsed back toward its real value. The outside investors, who had bought at the inflated price based on the false signals the pool had manufactured, were left holding shares worth a fraction of what they had paid. One of the most notorious examples was the radio pool of the late 1920s, in which a group of prominent Wall Street insiders, including members of the Radio Corporation of America's own management, drove up the price of RCA stock, one of the most popular stocks of the era, and took millions of dollars in profits before the price crashed back down. Joseph Kennedy, who would later become the first chairman of the SEC, participated in multiple stock pools during the 1920s and was reportedly involved in the Libby Owens Ford glass pool as late as 1933. He reportedly told a friend, "It is easy to make money in this market. We better get in before they pass a law against it." Bear raids operated in the opposite direction but were equally profitable for the people running them and equally ruinous for ordinary investors caught in the crossfire. A group of traders would identify a stock they believed was vulnerable, perhaps a company facing temporary difficulties or negative press, and begin selling it short in coordinated fashion. Short selling involved borrowing shares from a broker, selling them at the current market price, and buying replacement shares later at a lower price to return to the lender. The difference was the trader's profit. In a bear raid, the concentrated short selling created heavy downward pressure on the stock price, which triggered panic among ordinary investors who saw the price falling and assumed the company was in trouble. Those investors sold to avoid further losses, driving the price down further, creating more panic and more selling. When the stock bottomed out, the short sellers bought shares at the depressed price to close out their positions, pocketed the difference, and walked away. The whole operation could be completed in days, and the traders who executed it earned enormous profits without ever intending to own a single share of the company they had targeted. Bucket shops added another layer of fraud to an already corrupt system. These were storefront operations in cities and towns across the country that looked like legitimate brokerage offices, with stock tickers on the wall, chalkboards displaying prices, and clerks taking customer orders. But when a customer placed an order to buy stock through a bucket shop, the shop did not actually execute the trade on any exchange. It simply recorded the transaction in its own books and took the other side of the customer's bet. If the stock went up, the bucket shop owed the customer money. If the stock went down, the bucket shop kept the customer's money. The customer believed they owned stock. They did not. They had simply placed a wager with an unlicensed gambling operation that was dressed up in the vocabulary and visual trappings of legitimate securities trading. Thousands of small investors lost their savings in bucket shops without ever understanding that their money had never entered the real stock market at all, and none of it was illegal. No federal law prohibited stock manipulation, banned insider trading, or required companies to tell the truth to the investors buying their securities. No federal agency existed anywhere in the government with the authority to investigate any of it or punish the people responsible. The American stock market had been operating inside a complete regulatory vacuum that had persisted since the founding of the Republic, and the people who profited most from that vacuum had every incentive and every resource to make sure it stayed that way. Then, in the fall of 1929, the entire system collapsed under the weight of its own contradictions. The crash did not happen in a single day, though popular memory compresses it into one too. The decline began in early September, when the market peaked and started to slide. The first waves of selling triggered margin calls, forcing leveraged investors to put up more cash or sell their holdings. Many could not come up with the cash, so they sold, which drove prices lower, which triggered more margin calls, which forced more selling. The cycle fed on itself with accelerating ferocity. The worst came on October 28th and 29th, days that became known as Black Monday and Black Tuesday. On those 2 days alone, the market lost roughly 25% of its value. Trading volume was so heavy that the ticker machines that reported prices fell hours behind actual transactions. Investors who tried to sell had no idea what their stocks were actually worth until hours after the trades were executed. The trading floor of the New York Stock Exchange was described by witnesses as a scene of pandemonium, with brokers shouting paper littering the floor and men physically struggling to reach the trading posts. The Dow Jones Industrial Average, which had peaked at 381 points in early September, began a decline that would not bottom out until July of 1932, when it reached 41 points. The market had lost roughly 89% of its value in less than 3 years. Fortunes that had taken decades to build evaporated in weeks. The devastation was not limited to Wall Street. Margin calls forced millions of ordinary investors to sell their holdings at massive losses to repay the money they had borrowed from brokers. Brokers who could not collect from their overleveraged clients defaulted on their own debts to the banks. Banks that had invested depositors' money in the stock market or lent heavily to brokers and speculators found their assets wiped out. Thousands of banks collapsed across the country between 1930 and 1933, and with them went the savings of millions of ordinary Americans who had never bought a single share of stock, but whose money had been placed at risk without their knowledge or consent. The crash was the spark that ignited the Great Depression, the worst economic crisis the United States has ever experienced. The prosperity of the 20s, which had felt so permanent and so inevitable, revealed itself to have been built on leverage, manipulation, and a collective delusion that prices would keep rising forever. The bill for that collective delusion was now coming due, and it would be paid not by the insiders who had created the bubble and extracted their profits before it burst, but by the millions of ordinary Americans who had been lured in by the spectacle and left to absorb the losses. If you're finding this valuable and want to see more deep dives into the hidden stories that shaped America, hit that subscribe button. We cover the financial history behind the systems and institutions you deal with every single day. Now let me tell you about the man who exposed exactly what had gone wrong. In 1932, the United States Senate Banking Committee launched an investigation into the causes of the crash. The committee had been looking into the financial system since early that year, but the investigation had produced little of substance. The first 3 chief counsels hired by the committee had been ineffective, hampered by inadequate funding, limited authority, and the uncomfortable reality that many of the committee's own members had financial ties to the institutions they were supposed to be investigating. The investigation was widely regarded in Washington as a political exercise that would generate a few headlines, produce a thick report that nobody would read, and lead nowhere. The political pressure to find a scapegoat was growing, however. Millions of Americans had lost their savings. Unemployment was approaching 25%. Bread lines stretched around city blocks in every major city. The public wanted to know who was responsible, and the Senate committee needed to deliver answers or risk looking as complicit as the bankers it was supposedly investigating. Then the committee hired Ferdinand Pecora, and everything changed. Pecora was the son of Sicilian immigrants who had arrived in New York City when he was 5 years old. His father was a cobbler. The family lived in a tenement on the Lower East Side. Pecora had worked his way through City College and later through New York Law School at night while holding a day job, eventually becoming an assistant district attorney in Manhattan, where he built a reputation for meticulous preparation and fearless courtroom examination. He was 51 years old, largely unknown outside New York, and entirely unimpressed by the wealth and social standing of the men he was about to question. When the Banking Committee hired him as its fourth chief counsel in January of 1933, nobody in Washington or on Wall Street expected much. Pecora had 6 weeks before the committee's term expired and a budget so small that he did most of the investigative preparation himself, often reviewing thousands of pages of financial documents alone in his apartment late into the night. Building the case file that would make the hearings the most consequential congressional investigation since the Credit Mobilier scandal of the 1870s. What Pecora accomplished in those 6 weeks and in the extended hearings that followed after the new Congress renewed the investigation was nothing short of extraordinary. He personally examined the most prominent bankers and financiers in America, questioning them under oath in public hearings that were covered by every major newspaper in the country. The men who sat across from Pecora in that Senate hearing room were not mid-level employees or minor players. They were the titans of American finance: Charles Mitchell, chairman of National City Bank, the largest bank in the country; Albert Wiggin, chairman of Chase National Bank; J.P. Morgan Jr., head of the most prestigious banking house in the world; and Richard Whitney, president of the New York Stock Exchange. Pecora's questioning was methodical, precise, and devastating. He had done his homework, and the witnesses, who had expected a routine political hearing they could manage with vague answers and evasions, were stunned by how much Pecora already knew. The revelations that emerged from the Pecora hearings shocked the nation and transformed the public's understanding of what Wall Street had actually been doing during the years of prosperity. Charles Mitchell, who earned over $1 million a year as chairman of National City Bank, the largest bank in the country, had paid zero federal income tax in 1929 by fabricating a paper loss through a stock sale to a family member, a transaction that had no real economic substance and existed solely to eliminate his tax liability. Albert Wiggin, chairman of Chase National Bank, had used a personal shell company incorporated in Canada to short sell his own bank stock during the crash, betting against the very shareholders whose interests he was supposed to protect and earning over $4 million while Chase's stock price collapsed. When asked about it under oath, Wiggin saw nothing wrong with the arrangement. The J.P. Morgan firm maintained what became known as a preferred list of friends, allies, and politically useful contacts who were given the opportunity to buy stock in new offerings at prices far below what the public would pay. The list included a former president of the United States, Calvin Coolidge, a sitting justice of the Supreme Court, and dozens of senators, congressmen, and political figures whose goodwill the Morgan firm had reason to cultivate. The existence of the list made the cozy relationship between Wall Street and Washington visible to the public in a way that no academic study or newspaper editorial ever had. The Pecora investigation also revealed the staggering scale of the losses that ordinary investors had absorbed. Of the roughly $50 billion in new securities that had been issued and sold to the American public during the decade after World War I, approximately half had proved to be completely worthless. The companies behind those securities had either gone bankrupt, been fraudulently created, or been so poorly managed that their stock became valueless. Billions of dollars in American savings had been funneled into securities that the people selling them knew, or should have known, were junk. The hearings turned Pecora into a national celebrity and turned the American public decisively against Wall Street. Newspaper headlines described the revelations in language that made bankers sound like common criminals, which the evidence suggested many of them had been. Public demand for regulation became overwhelming, and Congress, which had been reluctant to interfere with the financial industry for a century and a half, could no longer resist. The first legislative response came in 1933 with the Securities Act, also known as the Truth in Securities Act. The law required companies issuing new stocks or bonds to provide investors with accurate financial information about the securities being offered. For the first time, companies had a legal obligation to tell the truth about what they were selling. The law also made it illegal to deceive or defraud investors in the sale of securities. But the Securities Act covered only new offerings. It did not address the ongoing trading of stocks on the exchanges, and it did not create a dedicated regulatory agency. That came the following year. On June 6, 1934, President Roosevelt signed the Securities Exchange Act into law. The act created the Securities and Exchange Commission, a new federal agency with broad authority to regulate the securities industry. The SEC was empowered to require publicly traded companies to file regular financial reports. It could regulate stock exchanges and the brokers who traded on them. It could prohibit manipulative trading practices, including stock pools, wash sales, and insider trading. And it could bring civil enforcement actions against individuals and companies that violated the new rules. For the first time in the 142-year history of the New York Stock Exchange, the federal government had the authority to oversee how stocks were traded. Then Roosevelt made the appointment that stunned everyone. On July 1, 1934, the president named Joseph P. Kennedy as the first chairman of the Securities and Exchange Commission. Kennedy was not a reformer, not an academic, and not a regulator. He was one of the richest men in America, and he had made a significant portion of his fortune through the exact same market manipulation practices that the SEC had been created to stop. Kennedy had participated in stock pools, profited from insider information, and exploited every loophole in a system that had no rules. He had been involved in the Libby Owens-Ford pool as recently as 1933, just months before the SEC was created. The reaction was immediate and fierce. New Deal liberals were outraged. Ferdinand Pecora, whose 2 years of Senate hearings had exposed the abuses that made the SEC necessary, arrived in Washington fully expecting to be named chairman himself. When word of the Kennedy appointment reached him, Pecora was reportedly furious. Jerome Frank, a prominent New Deal attorney, compared the appointment to setting a wolf to guard a flock of sheep. Newspapers across the country called it putting the fox in the henhouse. Senator Burton Wheeler of Montana said he could see no reason for the president's appointment of Kennedy other than the fact that Kennedy contributed heavily to Roosevelt's campaign fund. Even some of Roosevelt's closest allies privately questioned his judgment. Roosevelt's logic, however, was characteristically pragmatic and, as events would prove, remarkably shrewd. He needed someone who understood how the market actually worked from the inside, not just how it was supposed to work according to the law. He needed someone the financial industry would take seriously, someone who spoke their language and understood their methods. And he needed someone who had personally used every trick in the book, because only that person would know where to look for the tricks that others were still using. Roosevelt reportedly told an advisor, "Set a thief to catch a thief." Kennedy served as SEC chairman for 431 days, and his tenure, against all expectations and to the genuine surprise of his critics, was a success. He declared the SEC the partner of honest capital and pursued a strategy of cooperative enforcement rather than punitive crackdowns. He understood that the stock market needed to function, that capital needed to flow, and that an SEC that was perceived as hostile to business would drive investment underground rather than into the regulated market. He hired a high-caliber staff, established the agency's organizational structure, set up regional offices across the country, and began the process of requiring publicly traded companies to file the regular financial reports that remain the backbone of securities regulation today. The 10K annual report and the 10Q quarterly filing that every public company in America now submits are direct descendants of the disclosure requirements Kennedy's SEC put in place. Brokers who had dreaded the SEC's creation found Kennedy to be a surprisingly reasonable regulator who understood their business and wanted the markets to succeed, not to punish them. By the time Kennedy resigned in September of 1935 to become chairman of the Maritime Commission, the SEC was a functioning federal institution with a growing reputation for fairness, competence, and credibility among both investors and the financial industry it regulated. The story of the stock market before the SEC is a story about what happens when a financial system operates without rules, without transparency, and without accountability. For 145 years, the American stock market was a private club that policed itself, and the evidence shows exactly how well that worked. The people with the most information and the most access used both to enrich themselves at the expense of everyone else. The insiders made fortunes. The outsiders, the ordinary Americans who put their savings into a market they did not fully understand, bore the cost. It took the worst financial collapse in American history, a Senate investigation led by the son of immigrants who was not afraid to ask uncomfortable questions, and a pair of federal laws that the financial industry fought with everything it had to finally establish the principle that investors deserve to know the truth about what they are buying, and that the people selling it have a legal obligation to tell them. Every prospectus you receive, every quarterly earnings report a company files, every insider trading prosecution the SEC brings, every financial disclosure rule that governs the modern stock market traces back to the hearings conducted by Ferdinand Pecora in a Senate chamber in 1933 and the laws that followed. And the agency that enforces those rules was built from scratch by a man who had spent years exploiting the very system he was now charged with reforming. Roosevelt's gamble on Joseph Kennedy was either the most cynical appointment in presidential history or the most brilliant. The market's performance in the decades that followed suggests it was the latter.